Bitcoin is the cryptocurrency, and we think it's going to be the biggest one by far. Now, it's focused on, it's a monetary system, rules-based. The rule is quantity theory of money. So 21 million units, that's where it's stopping, and we're at about 20 million units right now. So that's quantity theory. Stablecoins are based, as I mentioned before, on the dollar, and if you can find a way to use those stablecoins, which you can, in the decentralized in DeFi, decentralized financial services, you can earn money. You can earn money from your stablecoins.
Cathie Wood starts off by pointing out a crucial difference that most people overlook. Cryptocurrencies and crypto assets are not the same thing. Because it is transparent, decentralized, and theoretically rare, Bitcoin is the purest form of digital currency, she explains. And as such, it dominates the cryptocurrency market. No central authority can print more of it since its supply is controlled by the quantity theory of money. Bitcoin's hard cap of 21 million coins, almost all of which have already been mined, provides it enduring worth in a world where printed money is everywhere. For further updates on Bitcoin and the wider world of digital assets, please take a moment to like this video, subscribe to the channel, and enable post notifications before we go any further. Thanks, and enjoy the video.
Supposed cryptocurrencies. We don't think there are going to be very many cryptocurrencies. In fact, there's cryptocurrencies and then crypto assets. Bitcoin owns the cryptocurrency space when it comes to pure crypto. And now we have stablecoins, which are cryptocurrencies as well, but they are tied to the dollar because they're collateralized primarily by treasury securities. So Bitcoin is the cryptocurrency, and we think it's going to be the biggest one by far. Now, it's focused on, it's a monetary system, rules-based. The rule is quantity theory of money. So 21 million units, that's where it's stopping, and we're at about 20 million units right now. So that's quantity theory. Stablecoins are based, as I mentioned before, on the dollar, and if you can find a way to use those stablecoins, which you can, in the decentralized in DeFi, decentralized financial services, you can earn money. You can earn money from your stablecoins. Just this last week, Coinbase introduced a product allowing holders of USDC who do not get the interest payments, they're not allowed to by regulation, but they're allowed to lend to loan their USDC in the DeFi ecosystem, and they can earn, as of last week, 10.4%. So Bitcoin serves three roles. And yes, and we would differ with
I know you
Tom.
get on very well with Tom.
And we do.
And you buy Bitcoin.
Yes. So the three roles, Bitcoin, as I mentioned, is the global monetary system. Rules-based, quantity rule to be sure. And that alone is a very big idea. It is also a technology. So layer one, blockchain technology, never been hacked. The other blockchains cannot say that, right? And so that's why the monetary system is based on it. And it is the first of its kind in a new asset class. We wrote our first white paper on that in 2016. So a new asset class. So it's got three very important attributes to it. I do think that Ethereum is playing a very important role, and therefore Ether, the native currency, in the DeFi ecosystem. A lot of the fees are going to the layer twos. Robinhood, for example, announced that it was going to start its own layer two, like Coinbase has. It's called Base. They get a disproportionate amount of the fees. Now, the question is, are there going to be so many layer twos out there that they're going to start competing against one another and confer more importance to the layer one? That is a possibility, and that is why we're invested in Ether, and we do think it powers the DeFi world. But I think these competing interests are maybe something that that Tom and I can debate a little bit.
They're always great debates
Yes.
when you have them. And
Very friendly.
And I know you're a buyer of Bitmine, the
And
company
Bitmine,
he's
absolutely.
a chair of. What about, is there a long list of other cryptocurrencies that you believe in, or is it actually a handful only?
It's really only a handful so far.
Which are the other ones?
Well, of course, we've got Bitcoin. Now, in our public funds, these trades are public, so I can tell you our exposures are Bitcoin, Ether. We're finally able to get an acceptable, from a regulator's point of view, way to play Ether, and we chose Bitmine Immersion. And and then Solana is the third one, and we can talk about that as well in terms of its role. That one is through, well, it's Brera Sports, and everybody thinks I or ARC just bought a bunch of sports teams, which we did not. This is the company into which Soulmate is a Solana treasury is being folded and supported by the UAE, Middle Eastern, and my mentor, our advisor, and my friend Art Laffer is on the board of that one. So that's been very interesting. So those are the big three. Hyperliquid is the new kid on the block, and we're waiting to see how that all plays out. It's exciting. It reminds me of Solana in the earlier days, and Solana has proven its worth and is there with the big boys. So those we think are. And then, of course, there are other services, Aave, like money market fund, and Uniswap, and a few like that, Jito, which is related to the Solana ecosystem. So we will play certain derivatives, but if you're talking about the big boys or girls, those are the big three right now.
She provides a clear illustration of how people can make 10% interest by lending USDC, while small borrowers, who are frequently turned down by regular banks, are able to obtain credit at last. Although there are hazards, Cathie adds that DeFi is really safer than many traditional financial institutions because of its transparency and excessive collateralization. The DeFi technology managed liquidations transparently on the blockchain during significant crises, such as the Three Arrows Capital and Luna failures, guaranteeing lenders' safety. In the meantime, investors were totally destroyed by centralized platforms like FTX, which functioned in secret. The irony, according to Cathie, is that trusting code on-chain proved to be far safer than a dishonest, centralized organization. To remain up to date on the most recent developments in Bitcoin, cryptocurrencies, and the digital economy, please take a moment to like this video, subscribe to the channel, and enable post notifications.
What's the advantage of doing that via a stablecoin if you're in one of those countries?
So, and you're right, there are two major stablecoins today. Tether is primarily outside the United States and outside Europe now, after Mika, or do you call it Micah or Mika?
Either. I don't know.
Okay, the regulation. So it dominates. The two have 90% of the market. Circle is, quote unquote, more regulatory compliant, certainly in the United States. And there is a Euro version of USDC in Europe, which has not taken off. So those are the big two. Now, why would we in the developed world, you understand the emerging world, and we thought Bitcoin was going to serve that role. So stablecoins coming along has taken some share from Bitcoin, which we didn't expect when we did our original analysis. So in this world, what we're doing is taking the middlemen out of financial services. And what are the middlemen? Incorrectly or in a not fair way, I used to say, these are the toll takers. It almost sounded nefarious, which it's not. All of those middlemen in the traditional financial world are there to lower the risk of a transaction to the various financial institutions participating. When we move into the world of blockchain technology, it's peer-to-peer. The middlemen go away. So the way I like to describe it in a way that's more understandable, for credit cards, it's automatic 2.5% tax on each transaction. Again, function of middlemen. That doesn't have to be anymore. We will, and the tax will be anywhere from 2.5% or 2% to 4% in the developed world, or 25% if you're doing remittances in the developed world, like say Nigeria. All of that flattens out and goes to fee-based to the blockchains, which will drop to 1% or less. So
where are those fees at the moment? Because it's not like the cost of crypto mining and transaction costs at the moment it hasn't got down to 1% yet?
No. All of this is going to happen over time. I mean, yes, if you're operating in the world of just crypto, I just gave an example of USDC, a person saying, hey, personally, I can lend that out for a 10.4% rate. I'm not going to get that anywhere else. So that's one side of it, and that's kind of a saving rate. And those who are borrowing at 10.4% could never get that rate. They're too small, that banks won't have anything to do with them. So that's the other thing that's happening because of DeFi. It is those who could not get loans, or the loans would be prohibitively expensive, now can. And savers, on the other hand, who are loaning the money out, they get a much better yield on their savings.
According to Cathie Wood, the two main stablecoins that dominate the financial industry today, USDC and Tether, have a combined market share of approximately 90%. While Circle's USDC is thought to be more regulatory compliant and has even created a euro version, which hasn't gained much traction yet, Tether mostly works outside of the United States and Europe. She points out that many people thought Bitcoin would take the place of digital currency in the poor world when stablecoins first appeared. Stablecoins, on the other hand, have surprisingly seized a portion of that use case by providing easy access to digital transactions and dollar stability. She goes on to say that DeFi has created new chances for borrowers and savers alike. In contrast to traditional banks, anybody can now lend USDC and earn interest rates of above 10%. At the same time, small borrowers who are frequently overlooked by big banks can now obtain credit at affordable rates. Although the dangers are greater, DeFi is surprisingly resilient because to its openness and excessive collateralization. In her closing remarks, Cathie reminds the audience that the global financial system is undergoing a historic transition from centralized, opaque control to transparent blockchain-based networks. However, she cautions that until society completely comprehends and accepts the potential of decentralized banking, individuals will continue to gravitate toward traditional assets like gold due to fear, confusion, and policy instability. Please take a moment to like this video, subscribe to the channel, and enable post notifications for future Bitcoin, macroeconomic, and digital asset content. And as always, happy investing.